S&P 500 equity risk premium has now entered a death zone territory where risk-reward ratio is starting languishing. But it doesn't mean you need to give every profit you worked out to the market outright. Leave some percent to market maker as well, okay? To not make them go in bust. However, does altruism on the stock market pays? You may not have a choice if you are unprepared for what's coming and reacting impulsively thereby. So, if you are lost amid these confusing market narrations from here and there, I'm very glad you got to Blockrevision to get navigated on what matters the most and what investing approach to take. So I'm very optimistic of our next 30 minutes as we are live and everything works fine right now. So without any further ado, let's kick off. Alright, so economy view is the element I want to ponder about with you. And yesterday we had this FOMC minutes. What has brought it to us? So the minutes said if where this 25 basis points at the meeting might be the most appropriate, while a few members favored or could have supported a bigger 50 basis points hike. So it means right now that we are assessing that this higher interest rate hike is valid to some extent, all right? To what probability rate we'll find out in the next slide. But right now, both Chair Jeremy Powell and the minutes indicated that officials are prepared to raise rates further to produce broader slowdown in the economy that tamps down inflation. So overall, financial conditions are consistent with the degree of policy restraint that the committee is putting into place in order to bring inflation back to its goal of 2%. This shift in sentiment lately helped tighten financial conditions, also somewhat potentially aiding the central bank as it fights to bring inflation under control. And so right now there are no excuses from rising interest rates by 25, but we are still estimating what will be the next one, as the April's one was expected to be the last hike, but right now it may this termination phase may get postponed. So right now, some of members, alongside Mrs. Loretta Mester, said that she seen a compelling economic case for a half-point increase during the last meeting, and that's a view that echoed later that day. So Powell, however, finds that right now the direction is clear, and they don't find the necessity of hiking this interest rate further, but everything is data dependent. That's why you need to watch updates on what's going on the market. And right here you have a target rate probability history, and you may find right here that we have with this 500 525 points got to around 24-25%. So it means that right now market is getting seriously considering further interest rates hikes. It's not half, it's just a quarter, but those threats are serious right now, especially after recent retail sales data. Right now, we are expecting that consumer sentiment may deteriorate. That's what the GDP is assessing out of the Fed's analysts, but we still need a justification of such. So that was about it. And then what about the reverse repo that we have also debated broadly about previous year. So this year, United States will again face the problem of meeting the debt limit, which will most likely be raised again. Recently, in order to speed up the negotiations, those Treasury has had to remove cash from Treasury's main account just before reaching the debt limit. That coincided with the end of the previous year. As we remember, that was a time where the major indexes has slided, and right in the beginning of January, it has rebounded remarkably. So this confluence is not accidental, in my view. Recently, Treasury department's main account for tax revenues and other government expenditures has reached its limit, and that's why we had to erase some balance in order to push the situation forward in order to get another threshold. We'll need to keep on too. So recently, Treasury released frozen liquidity from its account. The cap of it was likely to be reached on Q1 2023, which meant we were able to see additional liquidity in the markets during those weeks, and that was the January's effect. So we have risen of around 20% on S&P 500, and that was the element that pushed the sentiment much higher. So on the other hand, just after raising the limit, dollar liquidity may collapse due to rebuilding of funds for TGA and QT by the Fed. So when this raising limit usually is getting, normally it evaporates liquidity out of dollar, and that's what happened in the second half of January. But right after, we started noticing a very consistent march toward north. And you may ask, what's all about the reverse repo? So a certain problem is that still there is a large number of those operations right away, which reduces the amount of liquidity in the market. But as we find, every single directional moves ends up with a major spike that's remarkable for reaching at least local top. So I wouldn't care much about it, as Williams suggested. Reverse repo is just a buffer that the Fed can use if they like. So right now, the Fed, if we just head on to liabilities and capital liabilities, we can find that right now we are reversing that recent liabilities and capital turn from 340 hundreds to 560, and the Fed right now could also permanently change banks' capital ratio, making deposits more attractive. That would increase reserves. So as you can see, the decrease in this deposits should help increase the reserves of commercial banks, which would increase liquidity. But on the other hand, when it's dropping right right away, it finds that this liquidity has been drained. So right here, you can find that the moment of that the treasury has dragged that cash over the table um, on the market. On the market, we have found another 250 billion or over 250 billion dollars that improved the liquidity, and that also juxtaposed that recent bearish evaporation. So it can be seen right now that looking at reserves is very important for the behavior of S&P 500, and it was back very important in the past. So as we can find, if the money from TGA goes to the private market once again, we will have another spike forward. But as the recent capital action has been coincided with this liabilities and capital element that favored the necessity of rising the debt ceiling for US, that is a just a temporary tweak. And don't forget, we are in a quietening, tightening. Yeah, that's why the most likely trajectory for this gauge is to head on south. So that's the gauge you need to watch in order to be updated of what may come next, and that's one of the harbinger where the money will flow off next. So it means the liquidity is expected to be drastically reduced when the new debt limit will get eventually set, and it's very dear. So that was about it. Also, reverse repo, as you can find, it may slide eventually after reaching that quite visible and quite notable peak, but we'll find out and get you updated what's ahead. Also, during recent months, we've seen that economic surprise index has risen, but it's right now at the levels as it was back during beginning of 2022, where we were at very high valuations. That was the January ratings, and it's, in my view, very difficult to make the sustainable action upon the way, especially with this seasonality effect. That's where February and March are typically much less favorable for stocks than January. And so also this evaporation right now, evaporation of liquidity might be the catalyst for this economic surprise index to revert, at least in a medium time horizon. So right now we're gonna find that US economy and the currency of US dollar still plays in the world a first fiddle, and as we're gonna find, US dollar is still the one to gain after this recent correction that took us few months. Right now, the price action of US dollar is relatively strong, and it will take a while in order to pivot this once again. Maybe something will change in the March, but I guess the February price action still will be the downside one. So that's the US dollar that's visibly weighing on stocks and bonds, and there is not much reason to expect a change as long as the US economy remains resilient. So Fed needs to tackle with inflation, and nobody is to stop them from doing this. So will we see the pause on tightening at a time when inflation remains well above its target? I don't think so. So that was about surprise index. Right now, let's head on to the housing market. As you can find, US housing market hit with biggest 6-month wipeout since 2008, and the value of US housing market shrunk to the levels not seen since a decade. So after peaking at 47.7 trillion in June, the total value of US homes declined by 2.3 trillion, and it's an equivalence of 5%. So right now the housing market has slid some of its value, but most homeowners still reap big rewards from the pandemic housing boom. That's why I do find still that we have a room to correct. But also, when those slumps happening, there might be also some opportunity hunters in the air when do find that's the assessing that's just a mere correction, and as that's the lowest level since June 2020, that would mean that it's a great time to buy. Whether you are on the buying side or just waiting and anticipating for even lower valuations, let me know in the chat that's going live or in the comment section below the video right after episode. All right, so let's head on to market outlook and what's going on. With our indexes. So S&P 500 right now is touching at this trend line. What does it mean for us? It would mean that if we break lower, that I expect we will, as we've broken this horizontal line, another stop will be right at 3900s, and that would mean for us that we are once again getting back to this low 4000s barrier, and we may struggle within this area for longer. RSI is still at 50ish points, where after getting after this bearish tendency, this is normally a correction phase that this section, this 50 points threshold is the level of this sectioning the bears from bulls, as during a recent year we were in a bear territory. It would take us a bit longer than we recently have expected to get out and right away start a new bull. So S&P 500 right now in a as I attached in a thumbnail, in a dev zone, as it's to be or not to be area where this rebound out of this trend line is expected, but I wouldn't bet for it. Expected by the bulls, but it will be very difficult to validate it. All right, so it was S&P, and what about the further elements? Here we go again. So recently we've cheered after 20% growth on S&P 500, but from 1929 and 2008, there were at least 20 S&P 500 rallies during bear markets that failed to go on to extend the peaks. So there were durations of those bear market extending from from 2 days to 393. One had a trough to peak advance of more 60%. So we are not in the strongest bear rally among all, and it means that we are somewhere around this early bull and still late bear. That's why the relative cautious as expected from you, whether it's in trading or investing. What about the crypto outlook? So let's find out. Coinbase, we have went through it yesterday superficially, but I wanna just touch a bit more elements of this Coinbase earnings that recently found out. So adjusted loss during recent earnings were of $2.46 per share for the quarter. Also, that was beating estimates for a loss of 2.52 a share. Transaction volume fell 12%, 12% quarter over quarter to 322 million. So during this earnings call, that wasn't made maybe very optimistic for the whole sector. We've seen a speech of Brian Armstrong, that's a CEO of a company, that he asked to not extrapolate those results forward, pointing out that last year revealed just how fast the crypto market can change. That's why we cannot get biased in what happened back, as crypto has this power of very quick recovery prospects, and the expectation of the sector is that we may trade positively when this macro background will be upgrading. Also, there is an encouraging outlook regarding the seasonality of crypto market, where this period of 2023 is 1 year before a expected halving on Bitcoin that may boost the attention once again. Also, retail adoption is certainly up in the air, but just awaiting for regulatory standards, where coin custody, stable coins, and staking products will need to get regulated. So the next bulls will be initiated by those regulated companies, regulated sector that has may entail major and most important companies around Wall Street. So for now, regulations are the largest intrinsic barrier, but it may fade away very, very soon. So this Coinbase effect may spread over to whole sector, but don't get biased in such recent deteriorating returns. All right, so we are heading to market movers section, and for this one, as always, I'm eventually into economic calendar. What's up this week? This week we had on Tuesday inflation rate out of Canada. We've already talked about it. It was 5.9, better than as forecasted. IFO business climate out of Germany at 4 a.m. and this one is also improving. FOMC minutes out of US, and we are awaiting inflation rate from Japan and GfK consumer confidence. Also, we have had already GDP price index, GDP and GDP growth rate that's were a bit worse than the forecast, whereas price index has risen higher. So let's find out what's the trajectory right now. We are nowhere near from recession. That's why this this is another fuel for the Fed to hike even further. The economy doesn't show any signs of stopping this time. Right now, let's head on. Oh, I've attached it in a trade idea, but what I meant earnings season, just a little few cents on earnings season. We had Etsy. Sorry, I need to jump here and there. So we had Etsy on Wednesday. That was very important in terms of what's going on in this shopping industry. Shopping? Um, what's the shopping industry may point to us, and earnings calendar finding out that on Wednesday this Etsy worst has slumped, but mainly shares rose as much as 9% on the market, and we can find that despite this significant macroeconomic headwinds, Etsy maintained the vast majority of pandemic gains and delivered double-digit revenue growth and excellent profitability for the year. In terms of Nvidia, however, that surprised to the upside, and consensus EPS forecast right now favoring more growth on tech companies. So that was the most important names back. And then right now, once again, let's find out what about earnings season of today. It's Alibaba Publishing and Domino's Pizza alongside Moderna out of the healthcare sector to watch. What about Trade Idea though? On Trade Idea, I'm still sticking to my base scenario of WTI heading downwards. So right here you can find it. WTI should revert its tendency very soon, when after hitting this barrier of 73.8, it hasn't found a much of a negating signal that may push it upwards much higher. So in my view, after hitting the level of 75 or 75.5 in the best scenario, we may start reverting from here. And my base scenario was as this red line is leading, as right now I do expect that most of the indexes may revert and cross that important horizontal lines. So WTI, in my view, this time is to behave like this. So we may also update our arrow. So I do expect this one to stop right here. From there we would bounce and right after move downwards forward. So WTI should have its bear momentum within this or next section. Once again, I would stick to my previous call of having this this commodity trading back lower. And what I'm betting for is this accomplishing of Head and Shoulders formation. But for this one, we still need to close this this weekly candle right at the levels of 72.6 this or next week. Very important will be what may become this today's session price action, and whether the supply will turn up once again. In order to find out what's the price, what's the risk reward ratio out of this proposition, it will be with an extension of that line. It's at 11 points at this level. So if we get right to this level of 75.5, I would set my bet against this asset, and that is one of the possible play to work out. So I do expect that this rectangle, this rectangle is the right place to set your sell orders. So if the price will get out of this box, I wouldn't consider this this opportunity as valid for the making a trade. That's why you need to be aware of this, and it's limited by 75.1 and 75.6. So that's it out of today's video. Thank you very much for watching. If you have any questions, just put it in the comments section below, and we are seeing each other tomorrow at 8:45 AM.